consider this our very first comprehensive portfolio review. Today, we're going to look under the hood of a really common but honestly very dangerous financial fantasy. The internet is absolutely flooded with these get-rich-quick passive income dreams, right? They promise that the second you hit $1 million portfolio, you instantly unlock financial freedom, early retirement, and endless vacations. But the mathematical reality of wealth building, well, it's quite a bit different from the marketing hype. My goal today is to equip you with the hard truths and the actual mechanics of dividend investing. That way, you can build a bulletproof retirement plan that works in the real world, not just in your imagination.
Real quick, before we open up the books, I do need to share our standard compliance notice. This explainer is strictly for educational purposes and doesn't constitute personalized financial advice. Every individual's financial situation is totally unique, so you should always do your own due diligence or, consult with a professional before making any investment decisions. Okay, with that housekeeping out of the way, let's get down to the numbers.
All right, let's dive right into this. Here is the itinerary for our meeting today. We'll start by dismantling the million-dollar myth, contrast high-yield traps with reliable workhorses, and expose the silent wealth killers. Then we pivot to the solutions, the power of dividend growth, the hybrid portfolio strategy, and finally, how to create a self-reinforcing wealth cycle. So kicking things off with Section 1, the million-dollar myth.
When most clients sit down in my office and tell me they want to live off the dividends of $1 million portfolio, they're picturing, 50 or 100 grand flowing effortlessly into their bank account every single year without ever touching their principal. But here's where reality crashes into fantasy like a freight train. 1.2%. That is roughly the average dividend yield of the S&P 500 right now. Let that sink in. That means if you invest your entire hard-earned $1 million into the broad market, you're going to generate about $12,000 in annual dividend income. And that's before taxes. $12,000. That is a massive wake-up call for most folks who thought their millionaire status meant instant luxury.
To put that shortfall into perspective, recent data from the Bureau of Labor Statistics shows that the average U.S. household needs roughly $66,000 annually just to cover basic living expenses. That 12 grand from the broad market, it is definitely not going to fund your retirement paradise. In fact, it barely covers a few months of groceries and utilities. And this dramatic gap right here is exactly why investors start making desperate, dangerous decisions.
Which brings us to Section 2, traps versus reliable workhorses.
Now, when investors realize 1.2% won't cut it, panic kind of sets in, and they start hunting for yield just to bridge that gap. This fundamentally changes the risk profile of their potential investments. Now, what's really interesting here is the clear contrast between what looks good on paper versus what actually lets you sleep at night. Over on the left, we've got the flashy sports car, high-yield traps. Take Altria, the tobacco giant. It's yielding nearly 10%. Looks incredible, right? Until you realize their core business is literally shrinking every single year, and they're heavily using debt and cost-cutting to maintain that payout. On the right, we have the Toyota-like reliability of recession-proof Aristocrats. Companies like Waste Management yield a boring 3 to 4%, but their cash flow is rock solid. Why? Because no matter what the economy does, people still generate trash. I want you to remember this analogy because it's absolutely crucial. Spotting a dividend yield above 7% is like finding a designer handbag at a garage sale. There's probably a reason it's priced so low. Dividend yield and dividend safety operate on an inverse relationship. When a yield is sky high, the market is usually pricing in a future dividend cut or a fundamental business collapse. If a stock seems too good to be true, well, it probably is.
Moving right along to Section 3, the silent wealth killers.
So what if we avoid those traps and aim for a sensible middle ground? Say a high-quality ETF like SCHD that yields around 3.4% and pays out $34,000 on our million. Are we safe then? Well, not quite. Welcome to the hidden threats. The first silent killer is taxes. If you hold that sensible dividend fund in a taxable brokerage account, it creates immediate tax obligations. Unlike growth stocks where you control when you pay taxes by choosing when to sell, dividends hit you right away. If you're in a 25% tax bracket, your $34,000 instantly shrinks to $25,500. Just like that, a massive chunk of your wealth disappears to Uncle Sam before it even hits your checking account.
And then we have the second silent killer, inflation. Let's say you're 55 right now, and over the next 15 years, your dividend payouts actually grow. On paper, you might go from making $34,000 to a nominal payout of $50,000 by age 70. Sounds pretty great, right? But inflation relentlessly erodes that real purchasing power. In today's dollars, that $50,000 is only worth about $38,000.
So you're facing the harsh mathematical reality that even with consistent payout growth, you might barely be treading water. Let's look at the solution in Section 4, the power of dividend growth. So how exactly do we fight back against inflation, taxes, and low market yields? We shift our focus away from current, immediate yield, and instead, we embrace the incredible mathematics of compound growth. The core of this solution lies in Dividend Aristocrats. These are rare, exceptional companies that have proven they can increase their dividend payouts through recessions, market crashes, and economic upheavals for at least 25 consecutive years. The math here is literally stunning. A stock yielding just 3% today, but growing that dividend by 8% annually will actually double its payout in just 9 years. Fast forward 20 years and it's effectively yielding over 14% on your original investment.
The companies that actually pull this off are what I like to call essential financial plumbing. They solve really mundane problems for other businesses. We already talked about waste management, but consider automatic data processing. They handle payroll. Employees always need to get paid, right? Or federal real estate, which owns affluent shopping centers and has been growing its dividend for over 50 consecutive years. Look, these are unsexy, boring businesses, but that boredom, it translates into predictable cash flows, making them the absolute backbone of a serious retirement portfolio.
Okay, on to Section 5, the hybrid portfolio strategy.
So the crucial point is, how do we actually deploy your $1 million into these assets to generate meaningful income today while also protecting you for tomorrow? Well, we don't just dump it all into one bucket. We use a step-by-step masterclass plan called the hybrid portfolio strategy. We allocate 60%, so $600,000, into high-quality Dividend Aristocrats and ETFs to build a really stable foundation. Then we put 20%, or $200,000, into REITs, real estate investment trusts, for some diversification and a slight bump in current yield. But this final piece, it's the secret weapon. 20%, or $200,000, goes into growth investments that don't pay dividends at all. Why? Because you absolutely need capital appreciation.
And that leads us to Section 6, the self-reinforcing wealth cycle.
Let's look at how that 20% growth allocation actually functions over the course of decades. This is where we transition from basic theory to high-level execution, creating a system where you never actually have to drain your principal. Step 1. Your growth assets appreciate by roughly 8% historically. Step 2. You strategically harvest those capital gains during tax loss season, or you maybe even take a small loan against the portfolio's value. Step 3. You take that harvested cash and buy more dividend-paying shares. And this brilliantly illustrates how your growth investments act as an automated savings account that constantly feeds and expands your dividend machine without you ever touching your existing income stream. Now, let's move on and see how this builds into an advanced tax strategy, what I like to call three-dimensional chess with the tax code. During your working accumulation years, you hold your dividend stocks inside tax-advantaged accounts like 401ks to shield them from high income taxes, while keeping your growth stocks in taxable accounts. But when you retire and your tax bracket drops, you reverse it. You shift those dividend investments over to taxable accounts where the impact is much lower. Doing this maximizes your wealth retention at every single stage of life. And what's the ultimate reward for all this patience and structure? Well, if you take a $1 million ETF portfolio paying $34,000 a year, and instead of spending it, you reinvest every single penny back into the fund for 10 years, your portfolio grows to roughly $1.6 million. And even better than that, your annual income stream almost doubles to $54,000. You achieve real exponential growth just by letting the compound interest machine run totally undisturbed. Which brings our consultation today to a close, and it leaves you with one final, absolutely critical question. The reality of dividend income requires time, complex tax planning, and the discipline to invest in really boring companies. So, are you willing to build wealth patiently using these methodical strategies, or are you going to let the fantasy of instant riches lead you straight into the next high-yield trap? The choice is entirely yours, but hey, now you know the math. Thanks so much for joining me on this explainer, and happy investing!